Hello students. Well, today we're going to look at notes payable, another current liability, although certainly notes payable could be a long-term liability if the term of the note is more than 1 year. So it could be either, but right now we're going to look at an example of two short-term notes. So both of these fall into the category of a current liability. Now, one thing that could happen when you're recording a note is that you might have to record interest expense at year end. Now, our year end is going to be December 31, and we have one note here signed January 15. That's a 3-month note. So that's going to be repaid May 15. So, of course, we don't have to accrue interest expense at the end of the year. We're just going to pay this note on May 15 and recognize our interest expense at that time. However, for our August 31 note, we have a 6-month note, and that is going to cross over year end. So what we need to do is accrue interest expense for the time in the year that we have owed this money. And then we're going to pay it in the next year, and there will be another interest expense at that time from essentially January 1 until it's repaid. So this is going to give us our interest expense in the proper period of when we actually use that money and incurred a charge, which is interest. So we're going to first look at the very simple note where you don't have to accrue interest. And I just want to remind you that you do need to know the interest formula, the interest formula for calculating interest, which is going to be the principal amount times the interest rate times time. Now, the interest rate is always provided as an annual rate. So you'll see here that this is a 9% note. However, that means 9% for a year. You only owe this money for 3 months, so you're not paying 9%. In total, you're paying 9% of the yearly interest times 3 months out of 12. So that's how we're going to make sure we calculate our interest. So let's look at the first note, which is pretty simple. January 15, we signed a 3-month note, 9% note for cash. So we just borrowed cash and signed a note. So we got cash, and we owe a note payable. So credit notes payable. Of course, the amount is $20,000 and $20,000 again. So there's our note. Now let's calculate the interest expense that we're incurring for 3 months. Now up here I've keyed in 20,000 and 9%. Now what I'm going to do here is I'm going to put in a 3 and a 12, and the 3 here is for 3 months out of a year of 12. So 3 months out of 12 at 9%. So when we go to calculate this, we can just take our 20,000 and multiply by 9% and multiply by 3 divided by 12. And that gives us $450. So that is our interest expense for the 3-month period. So let's look then at paying this off in May. So here we have May 15. We know we're going to pay off our note. So let's make sure we do that. So I don't like the way, hang on. There, I want this to say May 15, not 15 May. Okay, so here's our notes payable, and we're paying off the principal of the note. So here we have 20,000. Now actually I'm going to put this on the second line because it's a little bit more traditional to put our interest expense first. So let's do that. Debit interest expense, and we we had determined that to be $450. Now, hang on. I need to bump this up so you can see it. There we go. There's our $450 interest expense. Now, we pay the principal of the note plus the interest. So now we have a cash credit. And that looks like we don't need a calculator. So here's us paying back the $20,450. Okay, so that was a nice simple note, right? Let's now turn our attention to the note signed later in the year where we will have to accrue interest. So August 31, we signed a 6-month 8% note for $60,000 as payment for equipment. So what we're saying here is that we gave this note to the seller of the equipment. We didn't get cash and then pay them cash. We just said, okay, we're buying equipment, here's a note. Now in real life, you probably put a down payment on there, but we're just going to go with the note for now. So August 31, and we have a debit to equipment. And a credit to notes payable, and of course that's for $60,000. So there's our equipment. Okay, now just a little aside here. I made this note August 31, and that's so that when we calculate interest, we're going to feel okay about rounding to the nearest month. So from the end of August to the end of December. Well, September, October, November, December, 4 months. So we're going to use 4 months out of 12. In reality, though, we have to count the days. So for expediency here and for efficiency, we're looking at just saying, oh, okay, we have to accrue 4 months of interest. Keep in mind that, if you go to a bank, you're probably not waiting until August 31 to buy equipment. Maybe you're buying your equipment like August 7. Well, you can't round August 7 to the nearest month. The bank is charging you interest for every day. You would actually have to figure out how many days of interest you're being charged. And instead of dividing months by 12, you would say, oh, okay, let's say August 7 is going to give us 24 days in August, plus 30 in September, plus 30 in November, plus 31 in December. So I forget what that is. But the thing is, like, that's how many days you would have divided by 365, and that would be your interest. So in real life, you're going to have to count the days if you do this. But for us, in school, one of the great things we can do in school is round off to the month. So let's accrue our interest on December 31. So our interest accrual, let's figure out the amount up here. So we know that from the end of August to the end of December is 4 months. So we're going to go 4 months out of 12. Now I've got the same formula going, so I'm just going to copy this down to here. And that gives me 60,000 times 8% times 4 months divided by 12 is $1,600. So that's my interest expense. Actually, I'll just copy this interest expense. So there's interest expense, and it is $1,600. Now, keep in mind, you're not paying this note until the due date. The due date is 6 months after August 31. So you don't pay any of this money on December 31. This is just you recognizing the fact that you have incurred an interest expense in the current year and recognizing that interest expense. But you're not giving them any money, so we need a different account title. So that becomes interest payable. So here's our interest payable. So we're sitting there with just want to mention an income state account, which is interest expense, and a balance sheet account, which is interest payable, which in this case is a current liability because it will be repaid within a year of the balance sheet date. So this interest expense is lowering our income for the year, and this interest payable is increasing our liabilities. So now let's figure out when we need to pay this. When it says 6 months, we need to go 6 months from the date of the note. Now that takes us to the end of February. There is no February 31 or 30 or 29 this year, so we're going to have to use February 28. Now again, this would be another good reason probably to count the days of this note. But I'm just going to, again, for some efficiency here, we're just going to use February 28. So, and we'll just call that a month. So we have February 28. Now just to note, this is year 2. It's a whole new year. So we only have one outstanding account. Well, 2 actually. We have interest payable outstanding, and we have our notes payable outstanding. Remember that interest expense as an income statement account was closed out to retained earnings on December 31 with your closing entry, so it's gone. However, we have incurred interest from January 1 to February 28. So how much is that? Well, I like to do this a very specific way, and this way you'll always get it right. I'm going to figure out the interest for the full note, the full 6 months, and then I'm going to subtract the amount we already accrued. So let's do that. We're going to say, here's our 60,000 and our 8%. Here's 6 months out of 12. So there's our 6-month note. And let's copy that down. And what we copied there, of course, was 60,000 times 8% times 6 divided by 12. So this is 2,400, and that is the full amount of interest on the note. However, we've already accrued 1,600 in the previous period. So what's our new interest? Well, our new interest is the difference between these two, 2,400 less the 1,600 already recognized. That's our $800. Now, just for fun, if you want to, take 60,000 times 8% times 2 months divided by 12, and you're going to get $800. So you think, oh, it doesn't matter how I do this. If you do it this way that I've just illustrated here, when the note is an odd amount of money or we're counting days, then you're going to get it right, and you won't worry about rounding off the same way 2 times. So it works better on maybe a note where you have to count the days, or it's more important than anyway. So we have new interest of 800. That will be 800 for January and February, and the previous year 16, totaling 24. Okay, so we're going to have interest expense again. So here's our interest expense, and the new amount is 800. Now we have to pay off our interest payable. Remember, that's a balance sheet account. It didn't get closed. It's sitting there in your current liabilities, and we need to pay off the previous interest payable. So let's do that. Here's our interest payable, and that was $1,600. We're also paying off our note. So let's pay off our note, and the note was 60,000. So now we have an idea of how much money we have to pay, which is simply the maturity value of the note, which is 60,000 times 8% times 6/12 for interest, plus the 60,000. So we add these together and we pay the cash. And that would be $62,400. Here's our total interest, $2,400, plus the $60,000 principal amount, so we pay $62,400. Now you'll notice that there are no accounts left on the balance sheet account. The notes payable has been paid, the interest payable has been paid, and now we have an interest expense in the current year. So that's an example of two notes for you, one of which we have to accrue interest, both of which are short term. And we may look at a long-term note in another chapter, but that's it for this example.